Data just dropped. SHFE, Shanghai Futures Exchange, just announced starting the last day of February. Participants without hedging quotas get 0 lots delivery allocation on all silver contracts. 0. This isn't speculation. This is official exchange policy, admitting physical shortage is extreme. OG John AG here. Let me be crystal clear. I will never ask for your money. Never. No paid signals, no courses, no mentorship, no invest with me. If someone using my name tries to sell you anything, it's a scam. Report it immediately. I make these videos because truth matters, not because I'm building a funnel. This is financial warfare education, not advice. Protect your capital. Verify everything. Stay away from anyone promising easy money. Quick update for those who missed the last 2 videos. We covered the shadow ban situation this channel's been facing and why reach has been suppressed. If you haven't seen those, go back and watch them. They explain exactly what's been happening. More importantly, there's a backup channel video dropping in a few hours that you need to see. The backup channel is OGANAG2. That's OG John Ag 2. Link is in the description below. There are no videos uploaded yet. That's how you know it's the original and only legitimate backup. Everything else using my name is fake copycats trying to scam you. The real backup has 0 videos right now and the handle is OGB2. Verify before you subscribe to anything. This isn't optional. If they hit this channel harder, that backup is the vault. The message continues there. Deeper, harder, no limits. And if you're getting value from this content, drop a comment. 30,000 of you proved it yesterday when they threw bots, clones, and algorithmic suppression at us. You responded with a tidal wave they couldn't ignore. You proved the machine breaks when people move as one. So drop a comment. Doesn't have to be long. Just let me know you're actually here, actually watching, actually paying attention. Now, back to the data. Current prices, as I'm recording, Silver Western Spot 85.90, Futures 85.40, Shanghai Spot 89.67, Shanghai Futures 92.29. That's a 3.77 premium between East and West for the same metal. Check the Shanghai Futures Exchange data yourself. It's public information available to anyone who actually looks. Here's what's happening right now that nobody's connecting. Just in the last 12 hours, silver has surged another 7 to 8%, adding $297 billion to its market cap. Silver just regained 35% from last Friday's overnight lows of 63.90 per ounce. 5 days, 1/3 recovery in less than a week. Think about that volatility. While that violent snapback was happening, SHF suspended 3 more groups of accounts today for trading violations. Total suspensions in 1 week, 20 account groups suspended on a major global futures exchange in 7 days. When have you ever seen that? Check. Article 16 of the SHF exchange regulation. It's all documented, publicly available. The ones who verify already know what 20 suspensions in 1 week signals. The ones who dismiss this without checking. They'll learn later when prices are higher. 861,000 ounces of silver left COMEX yesterday, 1 single day. March contracts being closed and rolled forward at an increased pace. If this pace continues, there should be sufficient silver in COMEX for March delivery. But that's a big if. Current open interest sits around 68,000 contracts. Do the math. That's roughly 340 million ounces of paper silver claims, registered silver actually in the vaults, 101 million ounces. That's a 3.4 to 1 coverage ratio. 3.4 paper claims for every 1 ounce of actual metal. COMEX data is public. The reports are dated, verifiable, accessible. Go check it yourself right now. Don't take my word for it. Additionally, open interest dropped by 2,000 contracts overall, signaling small short covering activity in the market. Bloomberg just reported gold demand surging in Hong Kong ahead of Lunar New Year. Retail clients snapping up small bars and coins as gifts. Trading volumes have soared compared to last year. Standard holiday demand story, right? But here's the line that matters. Bloomberg TV specifically reported supply constraints, especially in silver, are raising concerns about whether the momentum can last. Read that again. Supply constraints in silver. From Bloomberg, not from some conspiracy blog or alternative media source. From mainstream financial media admitting on air that shortage is real. They're just burying it in the middle of the story where most people won't pay attention. The ones who actually read past headlines, they caught it. Bloomberg also published a full article on China's big silver squeeze persisting even as prices steady. Mainstream coverage is finally acknowledging what's been obvious in the data for months. David Jensen just released new analysis on silver depletion. His assessment, the rapid decline of Western vault stocks of silver and surging silver lease rates for silver on US and London exchanges, indicates that metal is flowing out of vaults eastward as all silver vaults are rapidly depleted globally. Not just COMEX, not just LBMA, globally, all vaults depleting simultaneously. At the same time, overconsumption and underproduction of silver globally for decades means an increase in supply to market will require much, much higher prices. His conclusion on price volatility. While observers express worry about the pace of increase in silver's price and its volatility, they haven't seen anything yet. Check his full analysis. It's publicly available with data sources cited. The ones prepared to be early already positioned based on this type of analysis. The majority still waiting for CNBC to explain it in terms that make them comfortable. Now let me connect this to the geopolitical chess game the mainstream won't touch. China's share of U.S. imports just hit a 26-year low. 26 years they've been heavily decoupling from the U.S. for 5 years straight. The notion that the U.S. can damage China economically through tariffs on exports is increasingly disconnected from reality when China has already rerouted their entire supply chain away from U.S. dependence. And what's China doing while decoupling? Export controls on strategic metals, strategic hoarding, building the Shanghai premium that now sits at $377 for silver today. Physical metal in the East trading at a consistent premium to paper contracts in the West. That premium is the market screaming that physical is separating from paper. Verify the Shanghai premium data from the SGE. It's tracked daily, publicly available. Here's what the data shows about silver versus gold dynamics. The ratio of available silver to gold in economic terms is estimated at around 1 to 100. Society's dependence on silver through industrial applications far exceeds gold. Yet the supply situation is drastically tighter. Solar panels, EVs, AI data centers, 5G infrastructure, military applications, all consuming silver at rates that mining can't replace. People aren't switching to silver because gold is expensive. They're switching because silver's return profile is crushing gold's performance. The disconnect between paper pricing and physical delivery is becoming undeniable. The real price isn't what's printed on screens in New York. The real price is what exchanges can actually deliver when someone demands physical metal. That's exactly what these Shanghai premiums, SHF delivery restrictions, and vault drains are revealing. The paper price is increasingly fiction maintained by derivative contracts. The real price emerges when delivery is demanded and exchanges restrict allocation. Bank of America just added U.S. material stocks to their list of assets, showing bubble-like behavior alongside gold, silver, and South Korea's Kospi. They're using their new bubble risk indicator, publishing weekly updates highlighting frothy areas. BOFFA warns AI-driven innovation could fuel more unstable, bubble-prone markets going forward. So institutional banks are officially warning bubbles and metals. Clear sell signal, right? Except in the exact same week, Buffett issues bubble warnings. Wells Fargo raises their 2026 gold target to $6,100 to $6,300. That's over 20% upside from current levels. Their reasoning, geopolitical risks, market volatility, and strong central bank demand. Wells Fargo specifically called the recent pullback in gold a healthy correction after a sharp rally. Spot gold down over 10% from its late January record, driven by profit-taking after prices rose more than 15-20%. But their target implies they see this as a buying opportunity, not a bubble top. Two major banks, same week, completely opposite signals. That tells you institutional confusion about what's actually happening. So, which is it, bubble or breakout? The answer depends entirely on your time frame and what you're measuring against. Here's what the data actually shows when you step back. The S&P 500 versus gold has been in a massive 25-year bear market, down roughly 60% over more than 2 decades. Think about what that means. Decades of brilliant entrepreneurs working countless hours, technological innovation, productivity gains, the greatest companies in human history generating record profits. And it's all still underperforming a metal that sits in a vault, doing absolutely nothing. No earnings, no innovation, no productivity, just sits there. And it's crushing the performance of the entire U.S. equity market over a quarter century. The S&P 500 earnings yield is near 100-year lows. The only time it was lower, the dot-com bubble. So maybe the real bubble isn't in metals, maybe the bubble is in paper assets priced in devaluing currency. While everyone's been trained to think stocks only go up, gold has been destroying the U.S. stock market this entire century. While silver, with dramatically lower available supply, is showing even more violent price action on both sides. Now let me give you the bearish case because intellectual honesty matters, and you need to hear both sides. Silver 1-month lease rates just dropped to 2.69% after showing 4 to 6% daily moves recently. That kind of volatility in lease rates can indicate short-term over-upping unwinds or temporary market dislocations that don't necessarily signal long-term shortage. March comps delivery might actually have sufficient silver if the current contract rolling pace continues. We've seen situations before where doomsday delivery scenarios didn't materialize because enough positions rolled forward or closed out. The Shanghai premium at 377, while elevated, has been higher in previous cycles. This isn't unprecedented, and BOFA's bubble warning isn't meaningless propaganda. Assets that move too far too fast can and do correct violently, regardless of underlying fundamentals. We've seen it in every market throughout history. Momentum can reverse. Corrections can be brutal. Price can disconnect from fundamentals in both directions, up and down. This is financial warfare education, not financial advice. There are completely legitimate scenarios where paper markets continue suppressing price for months or even years through concentrated short positions, derivatives, manipulation, and coordinated central bank action. The 2020 JP Morgan settlement for $920 million proves precious metals manipulation is real, documented, admitted in court. But here's what that settlement also proves. Manipulation can persist for decades before breaking. JP Morgan was manipulating these markets for years, paying fines, then going right back to the same desks doing the same trades. So if you're expecting some imminent justice where manipulation ends and price discovery begins, you might be waiting a very long time. Paper markets have tools to suppress price that can last longer than most traders can stay solvent. But, and this is critical, every single one of those bearish delay factors assumes paper markets maintain control over price discovery. And that's the assumption that's breaking down in real time. The SHFE delivery restrictions starting the last day of February, the vault depletion happening globally, the 20 account suspensions in 1 week, the Shanghai premium persisting, the Bloomberg admission of supply constraints. These are all signals that physical is separating from paper. You can print infinite paper contracts. You can create infinite derivatives. You can leverage up synthetic exposure to any degree the regulators allow, but you cannot print physical metal. And when buyers start demanding physical delivery instead of accepting cash settlement, the entire paper pricing mechanism breaks. That's the setup developing here. Daniel Oliver from Mermerkin Capital just made the public case for gold reaching $12,595 on dollar collapse scenarios. His thesis is straightforward. The dollar's demise is unavoidable at this point. The end game is binary. Either the government defaults on debt obligations, or the central bank is ordered to buy all treasuries, which destroys the dollar through monetization. That's not some fringe conspiracy theorist on YouTube. That's a capital manager running institutional money, presenting the logical mathematical endpoint of current monetary and fiscal policy. Whether you believe his specific price target or not, the directional thesis is becoming harder to argue against when you look at debt trajectories and central bank balance sheets, and silver with its exploding industrial demand from solar, EVs, AI data centers, plus monetary demand, plus structural supply deficit, plus geopolitical fragmentation creating hoarding behavior. Silver is the leverage play on that exact same thesis. When gold moves, silver typically moves more violently in percentage terms. That's been true historically, and it's proving true again in this cycle with 35% recovery in 5 days. Here's what matters right now. COMEX registered silver at 101 million ounces versus 340 million ounces of open interest. SHF implementing zero-lot delivery restrictions starting end of February for non-hedgers. Bloomberg admitting on air that silver supply constraints are real. David Jensen warning we haven't seen anything yet on price volatility. Wells Fargo raising gold price targets to 6,000 plus, while Bank of America warns of bubbles. S&P earnings yield at 100-year lows, except for dot-com bubble. There's also a pattern worth noting. Commodities have been moving higher into U.S. market opens only to get crushed when New York trading begins. That suppression pattern has played out for years. Asian markets bid up commodities overnight. New York opens and smashes them back down. But that pattern is showing cracks. The Shanghai premium exists precisely because that suppression mechanism is failing. Eastern buyers are paying more for physical regardless of what New York prints on the screen. Watch the SHF delivery restrictions implementation starting the last day of February. Watch COMEX March delivery. Watch Shanghai premium daily. Watch silver lease rate volatility. These are the data points that tell you whether physical is actually separating from paper or whether this is just another cycle of volatility within the same suppression regime. Verify the SHFE announcement yourself. It's an official exchange policy change. Check the COMEX registered. Data updated daily, publicly available. Look up the Bloomberg coverage of Hong Kong demand and their specific mention of silver supply constraints. Look at Bank of America's bubble risk indicator methodology. Don't trust me. Don't trust the mainstream media. Trust primary sources. The ones who actually do that homework, who pull the actual reports, who verify the actual data. They see what's building here. They understand why 20 exchange account suspensions in 1 week matters. They know what 3.4.1 coverage ratios mean when delivery pressure increases. The ones waiting for CNBC to explain this in comfortable terms that don't challenge their worldview, they'll be buying at higher prices later, wondering why nobody warned them. The warning is right here. The data is public. The sources are verifiable. The question is whether you're the type who checks or the type who dismisses without looking. Invest with logic, not hype.